Well, good morning. I'm Nick Rees, Global Head of Natural Resources at National Australia Bank. And thank you so much for joining us for this panel discussion on evaluating key trends in project financing and investment. We have an expert lineup on the panel today. From Societe Generale, we have Regional Co-Head, Metals and Mining Asia Pacific, Deborah Caudle. From Taurus Funds, we have Director Galt. From Orion Resource Partners, Portfolio Manager Peter Rozenauers. And from Noble Group in Singapore, we have Stephen Motteram, Global Head of Asset Development. 2020 will be remembered as certainly the year of COVID-19, and amongst all of the tragedy and disruption, the energy and mining sectors have adapted and shown remarkable resilience. But what about funding? Peter, let me start with you. Is funding still available for energy and mining projects amidst COVID-19?
Thanks, Nick. The short answer is yes, it is. I think you need to break potential investments down into two areas. One is funds and banks and all providers of finance have their existing portfolio. So existing portfolio companies need to be looked after, and they're probably the priority. And then secondly, in terms of new investments, definitely, say capital continues to be mobilised, and the COVID issue is seen as a temporary type issue. Companies may be facing temporary liquidity issues, but asset values haven't really been compromised at this point in time. So I think, that whilst that is the case, the capital will continue to be mobilised.
And Deborah, what about for banks? How has COVID-19 affected lending activity and appetite?
Yeah, sure. It certainly has impacted it. I think some of the immediate impacts that we saw were perhaps a broad drawdown across all sectors of companies on their standby credit facilities. And this was happening across all banks, and as I say, all sectors, including the energy and mining companies, with companies really preferring to hold cash in a crisis in preference to having those available credit lines. But this is quite different to the GFC. This is not a financial system crisis, it's a health crisis. But what we've seen coming through the last couple of months has been an increase in funding costs for the banks. That's clearly been seen in the CDS trading levels on the banks. And so when it has come to putting new transactions on, we've seen those high liquidity costs being passed through and transactions being repriced in the market. So there's certainly been that aspect. As Peter said, there's been a focus and for some a prioritisation on existing clients, supporting them with their needs, whether it be additional credit facilities, relief on repayments, deferring of amortisation, and some of that has taken priority over taking on new clients. That's probably what we've seen in the last couple of months. As to what it means for the rest of the year, COVID-19 is something different from what we see in general commodity cycles. There's less certainty around prices, around exchange rates, and we've certainly seen large variations on both of those aspects. But what remains unclear is, a pandemic timeline and the economic effect is quite unknown. But that said, there's still projects that need to be developed. Banks still have a clear mandate out there to be funding those projects. So we're continuing to evaluate new opportunities and continuing to look to put new transactions on.
Deborah, thank you. And Gordon, what's been the experience at Taurus? Is private equity hunkering down to weather through the volatility, or is it poised for some counter-cyclical investment?
Well, no, I think we're ready to invest at any point. We've just raised some more funds to deploy, and others will have the same experience. So the limited partners that provide these funds ultimately come mainly from North America, but I think we're seeing some some interest to go back from even Asia and the Middle East now, calling without us calling them, because they want to put money to work at reasonable rates. So I do think the difficulty in pricing that Deborah stated there with commodity prices, you don't really know how to evaluate the supply-demand gap, because typically when prices drop quickly, which they have in a number of commodities, then projects that have got like 3 or 4 years or 5 years left, they shut and then they don't reopen. But the market prior to them dropping out had always expected that there'd be that tail of production coming through. So you'll tend to then get quite a bit of volatility until everyone works out which projects should be operating, which ones shouldn't. Now, I mean, typically in project finance, M&A, expansions, they're 3 different things, and they will all operate quite separately. So straight project development, for example, you'll probably have this hiatus where things stop for a while until everyone sort of gets realigned. And take Africa, for example, in South America, the virus is still building there, so people aren't going back there to sort of re-engage with their projects. But in Australia, they certainly are re-engaged, and there's a lot of gold projects in Australia, and a lot of them are getting ready for financing right now. So I think as the stats showed, there's going to be less financings in dollar terms and number this calendar year, but it has to catch up if people consume, and you've just got to have the production coming back again.
Let me bring Stephen in. Stephen, Noble Group, is very much at the front line of global supply chains for energy and mining products. What's the COVID-19 experience been for your business?
Yeah, thanks, Nick. So I'll echo some of the points, particularly Deb made about this being different from the previous crises. So 2008, 2015, the China credit crisis were more demand shocks to the system, whereas this has been both a demand and a supply shock. So for the traders like Noble, it's actually created opportunities along the supply chain. The dislocation and the volatility in prices equals opportunity. So broadly speaking, we've seen opportunities for stockpile financing in places such as South Africa for chrome and manganese, where there were shutdowns, but producers were stuck with stockpiles that they couldn't export, so they needed short-term financing. Likewise, in Australia on the iron ore side, with prices being strong due to the Brazil supply issues, you've had the marginal producer come back into the market and look for supply chain financing. The other big impact we've seen in the copper market has been the TCRCs in China starting to come down due to the supply tightness of concentrates out of South America due to COVID issues there. So a mixed bag, but certainly it creates opportunities. I think the China supply chains are still flowing pretty well now, but in many other countries, such as into India, for example, it's a bit slower, and certainly on the coal side, demand's a bit slower into other parts of North Asia.
Yeah. Okay. Well, beyond COVID-19, let's discuss some other key trends in project financing and investment across energy and mining. 10 years ago, we spoke a lot about the emergence of alternative or non-conventional sources of capital. And by this, we really meant alternatives to public equity and bank funding and the bond market, such as private equity and metal streaming and royalties and so on. Gordon, is this trend continuing, or has the alternative itself become quite mainstream?
Oh, look, I think it's become somewhat mainstream now that, and the proponents of projects are also far better educated about these products than they used to be. And so they've already done their homework when they come talking to you about what they'd prefer and what they wouldn't prefer. So, yeah, I do think that they're mainstream, and they'll continue to be used quite a lot.
And Peter, when companies are seeking funding for projects or even M&A activity, what are the key drivers for considering alternative capital sources?
I think the as Gordon says, that the message has got through to the mining companies that probably the most expensive capital that they can raise is equity, and that alternatives really give these companies the opportunity to do larger transactions faster, with less equity dilution for the shareholders. And that's really, I think, a key driver that that will continue to attract capital from the private credit markets, and that includes some sector specific type funds, and will also keep the the mining companies focused on what alternatives they had. I think the other interesting issue to consider is that alternative investments can need to be recycled in a defined period of time, and so that alternative funds are really, as they're seen as a de-risking event, quite often welcome the introduction of the more conservative forms of capital at the right point in the development of a project. So, comes a time, a number of years after the investments made by the alternative funds, that there can be a liquidity event for the funds as the more conventional forms of financing come into play. The two pieces of capital can coexist. I think that's a big development that probably 5 years ago wasn't so common. So, it is quite common in very large projects for the banks to work together with the funds in different bits of the capital structure. And then ultimately, banks are not the only source of capital welcoming the private equity funds, but some of the retail investors are. So, there've been a variety of liquidity events that have taken place, such as the establishment of royalty funds that have been sponsored by private equity groups who've spent, the better part of 5 or 6 years gathering a bunch of products, packaging them up and selling them to retail investors. So, there's a whole, I think what alternative funds and private equity has done is sort of increase the velocity of money through the financing value chain that's required by mining.
And I'll just say the knowledge of that is all on the internet now. So you can look up and see what deals Orion's done and what Noble's done, what SocGen, what Taurus has done. So if you're a person needing money, you can see what the deals are, what they look like, what the components of them are, and then you can sort of, pre-prepare yourself for going and getting organised with your money.
Yeah, I think just building on what Peter was saying, and as you said at the start, Nick, 10 years ago, we were starting to talk about the alternative funding sources, and they've certainly become much more mainstream now. But certainly in the recent years, what we've seen is now the traditional financiers, so the banks, working together with the likes of Orion, with Taurus, perhaps sometimes at the inception of a transaction on some of the larger deals where we're working together and participating in different parts of the capital structure, or if it is a subsequent takeout of the financing, perhaps 2 years down the track once something's been de-risked. So we do see that the two working together at times.
Stephen, maybe I'll go to you now. I mean, I think it's clear that it's been a challenging time of late for many commodity traders, particularly in Singapore. How is that impacting the availability and cost of funding for commodity traders, especially with funding really being the lifeblood of a trading operation?
Yeah, thanks, Nick. I think if you look back over the last 5 years, we had in 2014 the Qingdao Metals warehousing scandal around receipts entitled to product being used multiple financings. And I think that spooked some of the banks, and it certainly made banks a lot more cautious and careful about some of the metals financing in the sector. And then more recently in Singapore, we had the Hin Leong $800 million losses on the oil trading side. So I think, generally speaking, the traditional trade finance banks are becoming more careful about who they finance and what they finance. That has opened the market up a little bit to some alternatives. You now get alternative trade finance funds and whatnot, but some of those are more loan sharkish and have a slightly higher cost of capital. So what that's tended to mean is that the market in terms of bank trade finance is probably becoming a little more concentrated towards, say, the top 15 trade finance borrowers, the major trading companies, the major oil companies, for example. So over the last 3 or 4 years, they've probably accounted for, the top 15 have probably accounted for about 40% of the trade finance deal volume. Then the other comment I'd make for a trader like Noble, who has its roots in coal trading, is that the bank market in terms of trade finance is getting bifurcated. There are banks that are still willing to do coal financing, but there are many banks that are moving away from that. So I think in terms of the way traders structure their bank lines and their financing opportunities, they need to keep that in mind, that they may not be able to have one single syndicate of banks that just deals with all the products they trade, that they may need to bifurcate their own internal financing structures to deal with their different flows.
I mean, that's a good segue, Stephen, and I'm conscious we've just got a few minutes to go in this session. But I did want to turn to another big theme for project funding, which is environmental, social, and governance, or ESG, and the rise of responsible investing. I know the session before this was looking particularly at ESG, but Deborah, let me quickly go to you. How important is ESG in the provision of funding from banks?
I mean, it's the forefront of decisions. It's one of the key criteria that we're looking at when considering any transaction. So it's a real gating issue. We've obviously seen in the mining sector the consequences of when things don't go according to plan. So the Vale tailings dam failure, for example, really reinforcing the importance of those ESG practices. So it's absolutely central. But what I will say is, as we look at ESG and we look at things such as the energy transition and decarbonisation, what's very clear is the role of metals in that energy transition and the role of minerals. That's been recognised by the World Bank in their Minerals for Climate Action report. It's been recognised in the EU taxonomy as well. So there's a very important role for mining and for minerals to play in that decarbonisation trend that we see.
And Peter, ESG no doubt's an important consideration for Orion, but how is that embedded in your processes? I think you might be on mute, Peter.
Sorry, we have a good question, Nick. Look, just very quickly, it's become more and more important for our limited partners, for us to not just to become advocates for responsible mining. So, we have an external member of our investment committee, a lady that just joined our current investment fund. She used to run the World Bank mining practice and was one of the architects of all the basic ESG principles through her time in that role. So it's important not only when you make the initial investment, but it's also important through the life of the investment. So it's fundamental.
Well, I think we could spend another 20 minutes talking on that topic alone, but unfortunately we're almost out of time. So let me very quickly thank Deborah, Peter, Stephen, and Gordon for sharing their insights today, and thank you all for joining us, and enjoy the rest of Mind to Money Online Connect. Thank you.